What if the calendar turns to 2026 and the opening bell sounds like a scream from 1929? What if markets don't just fall, they break, as the past drags the present into the same undertow? The charts would be different, the tickers would be digital, the losses just as real. Because the mechanics of panic haven't changed as much as we like to believe. History doesn't repeat exactly, but in finance it rhymes loudly. Welcome to Hidden Finance, where we map the secret currents beneath the surface of money and power. Here, we don't chase headlines, we unpack the forces that create them. If you want to understand how yesterday's crises become tomorrow's, you're in the right place. Stay with me and we'll trace the arc from the roaring promise of the 1920s to the vulnerable geometry of 2026. The patterns are there, if you know how to see them. The 1920s were an age of speed, sound, and leverage. Radios brought the market into living rooms, cars carried the optimism of assembly lines, and the ticker tape whispered that fortunes could be made in a day. The United States stood tall as the world's creditor after World War I, while Europe rebuilt under the strict architecture of the gold standard. Credit was cheap, confidence was abundant, and a new middle class learned to buy not just products, but stocks. An economy flush with innovation met a financial system flush with debt. Speculation metastasized into culture. Investors could purchase shares with as little as 10% down, using margin loans that amplified gains and would later amplify pain. Brokers' loans swelled to more than $8.5 billion by 1929, a staggering figure for the time. An accelerant poured across a forest of optimism. Investment trusts, early cousins of funds, layered leverage upon leverage, promising diversification while secretly concentrating risk. It felt like a new era, and the few who warned against it were dismissed as relics of a slower age. Underneath, the monetary mechanics were tightening. The Federal Reserve, worried about speculation, raised interest rates through 1928 and 1929, while the gold standard rules pinned policy to a rigid orthodoxy. Capital flowed where rates were higher, pulling gold into the United States and pressuring other nations. The Fed signaled caution, but refused to sterilize speculation with targeted tools. Instead, it squeezed the entire economy's credit supply. With credit conditions brittle and markets euphoric, the system held until it didn't. The crescendo came quietly at first. Through the summer of 1929, newspapers printed forecasts of endless prosperity, and the Dow peaked on September 3rd at 381. The market's daily rhythm turned jagged, then violent, as money market rates spiked and whispers of forced selling crept across Wall Street. Party chatter turned to price targets turned to prayers. The music was still playing, but more chairs were being removed every day. October 24th, 1929, Black Thursday. A rush to the exits met too few buyers and the floor went soft. Reporters wrote of faces drained of color, of clerks clutching tickets while the ticker fell minutes, then hours behind. A consortium of bankers tried to stand in the doorway, buying marquee names to stem the tide. It worked for a moment as fear exhaled, and then inhaled again, deeper, darker. October 28th and 29th, Black Monday and Black Tuesday, the days when belief broke. Prices collapsed in waves, more than 20% across those 2 sessions, and margin calls became a stampede. There was no circuit breaker, no protective net of deposit insurance behind the banks that funded the frenzy. The new era ended not with a whisper, but with a sustained howl of sell orders that swallowed the street. The crash did not create the Great Depression, but it lit the fuse. In 1930, a brief rally sustained the illusion that the worst was over, while incomes quietly fell and factories idled. Then a policy mistake turned a bad cycle into a global contraction. Tariffs were raised under Smoot-Hawley, strangling trade when the world needed it most. Agriculture wilted, debtors defaulted, and bank failures flickered into the first of several panics. The optimism of an age met the arithmetic of deleveraging. In 1931, the crisis globalized. Austria's Kreditanstalt failed and shockwaves rippled through Europe's fragile banks. Britain abandoned the gold standard, buying breathing room, while the United States clung to its golden anchor and tightened even as the economy gasped. Capital fled weak points in the global system, creating runs that crossed borders before policymakers could draft statements. The rules that were supposed to create stability instead became a trap. By 1932, the bottom was a long way down. The Dow had fallen nearly 89% from its peak, a near erasure of a decade's wealth. Unemployment in the United States approached 1 in 4 workers, and the money supply shrank by about a third, less a recession than a collapse of the financial lungs. Soup lines formed, dust storms raked farms, and the public's faith shifted from markets to survival. Numbers on tickers had become lives in balance. Then a shattered orthodoxy began to change. In 1933, a nationwide bank holiday closed the system, and depositors returned to reopened institutions fortified by federal insurance. The United States suspended gold convertibility domestically and later revalued gold, loosening bindings that had turned policy into paralysis. Glass-Steagall separated commercial from investment banking. The Securities Acts established transparency and rules for markets, and the SEC was born to enforce them. The financial architecture of the 20th century took form, built on the ruins of an earlier one. The first turning point was hidden in the buildup. Leverage piled onto optimism with no systemic guardrails. Buying on margin was not new, but the scale was, and it drew money into a call loan market that could yank credit with a single phone call. On the way up, this magnified wealth. On the way down, it forced liquidation into falling bids. The lesson is simple and dangerous. Leverage turns price declines into avalanches. The second turning point was policy, specifically, the choice to defend rules and tariffs over jobs and credit. Smoot-Hawley throttled global demand just as banks needed borrowers. Gold standard rigidity forced central banks to defend metal, not people. Banking panics metastasized because lender of last resort action came late and weak, constrained by doctrine and gold drains. Mistakes compounded, and a cycle that could have been short became a generational scar. The third turning point was a regime change, a shift from a world ruled by hard money and market myth to one constrained by rules, insurance, and a central bank willing to fight crises. Deposit insurance restored trust, securities laws forced transparency, and separation of banking roles reduced conflicts. These were imperfect fixes, but they made the next panics less fatal. The system learned, at a high price. The consequences were immediate and human. Incomes collapsed, factories shuttered, home values cratered, and farmers lost land passed down for generations. The intangible cost, the evaporation of trust, seeped into everything from bank counters to dinner tables. Small businesses became small memories. A generation learned to count pennies and distrust promises. Capitalism survived, but the optimism that fueled the 1920s died of exposure. The global impact was broader still. International trade fell by roughly 2/3, a gutting of commerce that reshaped geopolitics. Extremist movements fed on joblessness and humiliation. The 1930s produced nationalism in the streets even as central bankers argued in quiet rooms. The crisis reorganized power, bending nations inward and fragmenting the cooperative spirit that had barely taken root. Finance is never just finance, it is the bloodstream of the modern world. In the long run, the Depression built the institutional scaffolding of the post-war era. Keynesian economics challenged austerity, and governments assumed a larger role in stabilizing cycles. The Bretton Woods system would later replace the old gold standard with a more flexible order, tethered but adjustable. The point wasn't perfection, it was resilience, born from the fear of a 1929 replay. So why even whisper 2026? Because some conditions that made 1929 devastating have modern cousins. Asset prices in recent years have soared on narratives of technological transformation, while market concentration has hit highs not seen in decades. When a handful of giants steer the index, the market feels safer than it is, until one of those giants stumbles. Euphoria rarely announces itself as a risk, it calls itself the new normal. Leverage hasn't vanished, It has changed its clothes. Today, exposure doesn't show up only in classic margin debt. It hides in options with near zero days to expiry, in structured products, in total return swaps, and in credit extended outside traditional banks. The plumbing that links dealers, hedge funds, and passive flows is efficient in calm seas and fragile when waves collide. You can't call the loan this time with a telephone. The market calls it for you in milliseconds, via margin engines and risk limits that don't care about hopes. Liquidity can be an illusion in the age of screens. Exchange-traded funds feel like instant exits until the underlying assets freeze. We learned that in March 2020 with treasuries and in 2022 with UK pensions. The day-to-day calm of low volatility sedates the eye, but compression of risk is not elimination of risk. It is storage. 1929's investment trusts promised diversification and delivered correlation. Some modern products may rhyme with that story when pressure arrives. A crowded doorway remains a crowded doorway. No matter how high-tech the building, debt adds gravity to everything. Sovereign debt loads are high, and interest expenses have swollen as rates rose to fight inflation. Corporations face a wave of refinancing in 2025 to 2026, rolling low-cost pandemic here a debt into a higher-rate world. If growth slows or margins shrink, credit spreads can widen quickly, turning affordable debt into a survival question. A refinancing wall is not a crisis by itself, but it is a weathered cliff in a storm. Banks are safer than in 1929, and yet, we've seen how quickly confidence can flee. In 2023, depositors moved billions with taps, not lines, and a handful of institutions were undone by duration risk they thought they could manage. Commercial real estate remains a pressure point as office values adjust to new work patterns, and regional banks are not designed to hold a city's worth of empty floors. Add the rise of private credit, a vital source of funding, but outside the full glare of regulation, and you have leverage and liquidity living in new neighborhoods. Globally, the system feels brittle as supply chains remake themselves and geopolitics harden. Major economies lean into industrial policy, defensive tariffs, and strategic sanctions, a quieter, modern version of fragmentation that can thicken the arteries of trade. Energy shocks and war still do what they have always done. They raise costs, scramble expectations, and force central banks to choose between pain now and pain later. When the world moves in blocks, financial contagion may flow differently, but it still flows. What could make 2026 echo 1929? Not a single villain, but a convergence, an overconfident market leaning on leverage, a funding shock as rates stay higher for longer, a policy mistake that arrives late and hard, and a catalyst no one priced. The trigger could be a tax in liquidity rather than a tax in law, auctions that tail, a crowded unwind in derivatives, a foreign institution's stumble that reveals hidden exposures at home. A week that begins with shrug-off volatility could end with forced sales and frozen bids. The shape of panic changes, the physics do not. Picture the day a mega cap misses guidance, options flow floods the tape, and dealers hedge in a way that accelerates the fall. ETFs gap, credit ETFs gap more, and suddenly the phone lights up at desks you didn't know were linked. A real estate trust suspends redemptions, a private credit fund gates. A mid-sized bank issues a late-night press release about loan loss provisions. The algorithms are working. That's the problem. They are doing exactly what they were told to do, all at once. And yet, the differences matter. Central banks today are lenders of last resort in ways their ancestors were not. With swap lines, standing facilities, and a crisis playbook inked in 2008 and updated in 2020 and 2023, deposit insurance catches runs before they hit the sidewalk. And fiscal policy can arrive faster if politics allows it. Transparency is better, data flows are faster. Coordination is possible. We are not doomed to repeat 1929 unless we choose not to learn from it. What, then, are the lessons that travel across time? Watch the four A's: leverage, liquidity, linkages, and leadership. Leverage is the accelerant. Liquidity is the oxygen, linkages are the wind, leadership is the firefighter. The first three can turn a spark into a wildfire. The fourth decides how much forest survives. 1929's great error was to pretend that the fire would put itself out. There's a personal echo too. In 1929, the market was someone else's game. Today, millions hold their future in index funds and 401ks, in homes whose values depend on rates, in jobs tied to cycles they can't see. That makes prudence not just a policy choice, but a civic one. The more we understand how fragility forms, the less likely we are to let it surprise us. The goal is not to predict the day, it is to recognize the architecture of risk. So if 2026 threatens to rhyme with 1929, it will be because we ignored the buildup, misread the signals, and treated history as ancient instead of urgent. We can choose differently, to de-risk quietly rather than panic loudly, to coordinate policy early rather than heroically, to remember that markets are human stories written in numbers. Crises are not acts of nature, they are outcomes of structure and choice. And choices are still ours. You've been watching Hidden Finance, because the past isn't behind us, it's the map of our next crisis.